July 2026 did not arrive as a headline. It arrived the moment people opened their student loan accounts. They expected the same low payment they had seen for months. Instead, they saw a number that did not fit their budget. They refreshed the screen twice. The number stayed. That is how the change felt for millions of borrowers on July 2nd. On July 1st, the SAVE plan ended. The income-driven option millions had relied on was terminated. Borrowers were given 90 days to pick a new plan. If they did not choose, the system would choose for them. Many had done everything the old rules asked. They enrolled in SAVE. They recertified their income every year. They stayed current even when the payment was zero. They built their lives around the math the plan allowed. That math is gone. SAVE had tied payments more closely to actual income. It limited how fast unpaid interest could grow. It created clearer paths toward forgiveness for those who stayed inside the system. For a nurse in rural Ohio, a public defender in Chicago, or a teacher carrying 2 degrees, that structure was not a loophole. It was the only way the numbers worked. Now those same borrowers are being moved toward the repayment assistance plan and the standard or tiered standard options. For many, the new monthly amount is higher. Some borrowers are losing protections that once limited how fast unpaid interest could grow. For many, the timeline before any possible forgiveness has become longer under the new options. The payment was never just a number on a screen. It was the difference between covering rent and falling short. It was the reason someone could say yes to a slightly better apartment, or no to another year of putting off children. When that number moves, everything else moves with it. The transition has been uneven. Servicers began sending notices after July 1st. Some borrowers received them within days, others are still waiting. Many were placed into administrative forbearance while they figure out their options. Forbearance sounds like relief. In practice, interest often continues to accrue. The balance can grow quietly while people wait for clear instructions. Those instructions have sometimes contradicted each other. One notice says one thing. A phone call the next day says something else. Online guidance has not always matched what borrowers were told the week before. A person trying to make the biggest financial decision of their year is navigating conflicting messages from the same system. The language is technical. The consequences are not, because financial decisions do not happen in isolation. They shape the apartment someone signs a lease for. They shape whether someone stays in a lower-paying public service job. They shape whether a couple decides this is the year they can afford childcare. Move the monthly number, and those calculations shift overnight. Consider what that shift actually looks like inside one household. A borrower who had been paying $120 a month now faces nearly $400. The extra $280 does not come from nowhere. It comes from the car insurance payment that gets skipped this month. It comes from switching groceries to the cheapest store brand and cutting fresh produce in half. It comes from the conversation with a partner that ends with, "Maybe we wait on that." It comes from the small emergency fund that no longer gets added to. One number moves, and an entire month rearranges itself around the hole it leaves. That is what payment shock actually does. It does not just change a spreadsheet, it changes what someone can say yes to and what they have to say no to before the month even starts. The risk does not stop at the new bill. If payments are missed, the consequences move quickly. A missed payment becomes a delinquency. Continued non-payment can lead to default. Default brings collection costs and damaged credit. In serious cases, it can lead to wage garnishment, money taken directly from a paycheck before the borrower ever sees it. For someone already living close to the edge, that is not an inconvenience. It is the line between stability and crisis. Credit damage does not stay inside the loan portal. It follows people into apartment applications, into car loans, into mortgage approvals. It changes the interest rates they are offered and sometimes whether they are approved at all. The quiet sense that their financial life is no longer fully under their control grows heavier. Then there is the question of what was promised at the end. For years, borrowers working toward public service loan forgiveness were told that consistent qualifying payments in the right plan would eventually clear the remaining balance. That promise shaped career choices. It shaped where people lived. It shaped what they said yes or no to in their 20s and 30s. Now many are unsure whether months already counted will still count after the switch. They are unsure whether the new plan preserves the same path. They are unsure whether any future forgiven amount could be treated as taxable income depending on rules that may still change. Forgiveness used to feel like a finish line. For many borrowers right now, it feels like another moving target. The frustration is not that repayment is difficult. The frustration is that the difficulty arrived after people had already organized their lives around a different set of rules. They chose careers based on expected payments. They chose housing based on expected payments. They avoided private refinancing specifically to keep the federal protections that were in place at the time. They did not ignore their loans. They stayed inside the system they were told would reward staying inside it. When the system changes the terms after the fact, the people who trusted it most feel it first. That is what makes July 2026 different from a routine policy update. It is not only about higher monthly amounts or longer timelines. It is about the sudden realization that the map people were following was redrawn without warning. The low payment that let them breathe is gone. Some borrowers are losing protections that once limited how fast unpaid interest could grow. For many, the timeline before any possible forgiveness has become longer under the new options, and the institutions explaining the new rules are often the same ones that created the old ones. Student loan debt has always taken money. What it takes now for many borrowers is something harder to replace. It takes the ability to plan. It takes the sense that the rules will stay stable long enough for the plan to work. It takes the small margin that once existed between making it and falling behind. A balance can become a shadow over every adult milestone. Moving, marrying, having children, buying a home, saving for retirement, investing in anything beyond the next payment. For millions of people right now, that shadow just grew longer and darker. The payment is not only a number. It is the thin line between current and behind, between stable and spiraling, between a future that felt delayed and one that suddenly feels canceled. Millions of borrowers followed the map they were given. Then the map changed. The most expensive part of student debt in 2026 may not be the interest rate. It may be trying to build a life on rules that can be rewritten after you already trusted them.